Welcome to Dinar Shift. Today, we take an in-depth look into one of the most misunderstood elements of Iraq's post-war financial system, the $25 in Iraqi Dinar note. For years, discussions surrounding revaluation, redenomination, and exchange logistics have focused heavily on rate predictions. Yet few have taken the time to explore a more grounded and often overlooked question: why do banks, both within Iraq and internationally, seem to favor larger denominations like the 25,000 note over smaller ones? In this extended report, we break down the operational, logistical, and economic reasons behind this reality, reasons rooted not in rumor or speculation, but in hard financial mechanics and policy design. The story begins within Iraq's own banking infrastructure. Since the Central Bank of Iraq introduced the new Iraqi Dinar series in 2003, large denominations have served as the backbone of domestic liquidity and currency circulation. The 25,000 note, though controversial among currency watchers, became a practical necessity in a country still rebuilding from years of conflict and inflation. When physical money holds low real purchasing power, larger notes reduce transaction bulk, simplifying payments, payrolls, and even cross-border settlements. In other words, the note wasn't designed for symbolism, it was designed for function. From an operational perspective, handling large denominations drastically reduces cash management burdens. Imagine a typical commercial transaction in Iraq's energy or trade sector. A contractor receiving several billion dinars in payment would prefer a few bundles of high-value notes to truckloads of smaller ones. Fewer notes mean lower transportation costs, smaller storage space requirements, and easier auditing during central bank oversight. In that sense, the 25,000 note acts as a stabilizing tool in cash-heavy economies where digital banking penetration remains limited. Bank tellers and financial institutions echo this preference for another reason: efficiency. Cash counting machines, counterfeit detection devices, and branch-level verification systems are optimized for speed and volume. The fewer notes a machine must process, the faster a transaction clears. When the Central Bank of Iraq conducts liquidity injections or collects deposits from state-owned institutions, processing large denominations means reduced wear and tear on hardware, fewer labor hours, and higher accuracy. It's not about favoritism, it's about workflow optimization. On the global side, correspondent banks and foreign exchange desks often mirror this operational logic. When physical IQD holdings enter international custody chains, for example, through repatriation or authentication requests, larger notes streamline the process. They simplify logistics and reduce risks of mishandling. Major global custodians use standardized packaging and barcoding systems that treat each note batch as a registered security. The smaller the number of physical units per shipment, the more secure and traceable it becomes under Basel III banking standards. Yet this banking reality often clashes with how investors and observers perceive the dinar landscape. Many holders of smaller denominations believe that smaller notes may someday become more valuable in a post-revaluation environment. However, from an institutional standpoint, value is measured not in symbolic size but in processing stability. The 25,000 note remains a keystone denomination for accounting and settlement until Iraq's monetary base undergoes formal redenomination, a step that requires months, if not years, of planning, education, and digital transition. Importantly, the Central Bank of Iraq has consistently emphasized that all denominations are equally recognized under law. The distinction between large and small notes does not imply priority or exclusion, only operational preference. When officials reference modernization, they often speak about enhancing payment systems rather than withdrawing existing notes prematurely. That distinction matters because efficiency-focused policies are designed to preserve liquidity, not to signal hidden revaluation activity. There is also a cost dimension often missed in public debates. Printing currency, regardless of denomination, is expensive. The central bank contracts international firms for high security paper, inks, and embedded features. Producing billions of smaller notes would require not only greater financial expenditure but also expanded storage, transportation, and security networks across the country. By contrast, maintaining circulation through a smaller number of higher-value notes reduces annual printing and replacement costs, a prudent fiscal measure for a country balancing reconstruction budgets. As part of its modernization efforts, Iraq has increasingly digitized government salary payments and business transfers. However, cash remains a vital instrument, especially in rural regions where digital infrastructure is limited. In these areas, the 25,000 note facilitates high-value exchanges without overburdening the population with stacks of smaller notes. For instance, a farmer purchasing agricultural machinery or fuel in a cash-based economy benefits from compact, high-value notes. The convenience alone strengthens trust in the banking system and reduces black market dependency. This operational logic also extends to Iraq's private banking sector. Commercial banks tasked with disbursing government contracts or oil-related payments must handle enormous sums daily. Whether settling vendor invoices or transferring funds between departments, higher denominations enable smoother reconciliation between central and regional accounting systems. These efficiencies form the unseen foundation of Iraq's banking modernization strategy, an infrastructure built not on speculation but on logistics. Now, when observers see reports suggesting banks prefer the 25,000 note, it's not a policy declaration but a reflection of internal efficiency. For example, many teller software systems and counting devices are programmed for denomination weighting, meaning their counting and bundling algorithms process higher value notes faster. The result is measurable shorter lines, lower error rates, and improved auditing compliance. In a sector where time and accuracy equate to trust, that preference is practical, not political. Interestingly, Iraq's neighboring economies have gone through similar phases. During high inflation periods, nations like Turkey, Iran, and Zimbabwe temporarily relied on large denominations to stabilize daily transactions. While each country's outcome varied, the underlying principle remained consistent. Until structural reforms could reduce inflation, large notes served as tools of convenience and control. Iraq's 25,000 note fits this same transitional logic. It's a bridge between old monetary instability and future reform, not a permanent fixture. The Central Bank of Iraq's long-term plan has always included the introduction of smaller denominations after redenomination. Yet officials have made clear that such a process would only occur once inflation, exchange rate stability, and banking digitization reach target levels. Until then, the high denomination structure remains efficient and cost-effective. This explains why, even in 2025, the 25,000 note continues to dominate both domestic and institutional cash handling. From a regulatory standpoint, large notes also aid compliance. When commercial banks report to the central bank under anti-money laundering's AML and counter-terrorism financing (CTF) frameworks, handling fewer physical units simplifies traceability. Every bundle can be serial numbered, photographed, and logged through scanning systems connected to the CBI's real-time monitoring platform. This degree of control would be nearly impossible if every large transaction involved tens of thousands of smaller notes. At the retail level, Iraq's economy still reflects a dual currency dynamic, the coexistence of cash and digital payments. Many Iraqis trust cash more than electronic transfers due to historical experiences with system outages and corruption scandals. In that context, the 25,000 note maintains stability as a familiar, practical store of value. It may not be ideal for long-term reform goals, but in the short term, it prevents transactional paralysis and keeps liquidity circulating through formal channels rather than informal markets. Moreover, the note's continued dominance aligns with Iraq's broader economic policy goals. By sustaining a manageable number of denominations, the central bank can standardize banking equipment, streamline audit procedures, and focus its modernization budget on digital expansion instead of physical printing. In other words, the 25,000 note remains part of a calculated balance between modernization and cost efficiency, a strategy that will likely persist until Iraq's economic diversification fully matures. In international finance, perception often shapes narratives, but operations shape outcomes. The 25,000 note's prevalence tells a quiet story of practicality, not politics. It represents how developing economies stabilize daily life amid reform, by choosing the path that minimizes friction in the real economy. As our analysis continues, it becomes clear that the real story behind denomination preference lies deep within how modern banking infrastructure operates. When we step inside the internal workflow of a large financial institution, every single movement of currency is mapped, monitored, and reconciled. This system, designed to ensure absolute accuracy and compliance, must function smoothly under enormous pressure during any large-scale exchange event. The preference for the 25,000 note is not born out of speculation. It emerges naturally from this mechanical, procedural reality. A single note carrying greater face value saves hundreds of individual verification steps when scaled across thousands of transactions. Imagine a standard high-volume processing day at a major bank. Teams of tellers and compliance officers handle streams of customers, each presenting their holdings for exchange. Every note that crosses the counter must be inspected under specialized scanners, fed into authentication devices, and its serial number captured in a secure database. When this process multiplies by thousands of participants, the difference between handling 40 large notes or several thousand smaller ones quickly becomes substantial. Time, accuracy, and physical space all become measurable assets. The 25,000 note simplifies this workflow in a way no other denomination can. One of the least understood aspects of modern currency handling is machine calibration. Currency verification systems are highly sensitive to size, texture, and optical patterns. Each denomination requires calibration profiles that define how sensors recognize genuine notes. In the case of the Iraqi Dinar, smaller denominations could potentially require additional manual adjustments during intake, slowing down throughput. Large notes processed in smaller batches reduce the likelihood of system delays and help maintain continuous operational flow. For institutions managing redemption events, this difference translates directly into higher capacity and lower error probability. From a compliance perspective, larger denominations also minimize exposure to risk. Every note must pass anti-counterfeit and anti-money laundering filters. The fewer the notes, the lower the chance of error in scanning or data entry. When each note carries significant value, it becomes more efficient to reconcile the total against Treasury authorized exchange reports. This layered process ensures that not only is the currency genuine, but also that the transaction chain remains traceable and transparent. Banks thrive on audit trails. Fewer notes mean a cleaner audit path. Let's also consider the physical logistics of bank operations. Cash handling is not simply about verification. It includes transportation, storage, and security. Vault space is finite. Armored transport must be calculated by weight and volume, and security procedures follow strict capacity limits. Larger notes optimize every link in that chain. A single shipment of 25,000 notes can represent millions in value while occupying a fraction of the physical space smaller bills would require. This optimization extends from teller counters to regional storage facilities, saving both time and operational cost. As institutions scale their systems to prepare for potential currency exchanges involving the Iraqi dinar, efficiency becomes the governing principle. High-value notes like the 25,000 denomination allow banks to process larger sums with fewer mechanical interactions. When measured across thousands of customers, this means significantly reduced transaction bottlenecks. In a controlled environment where each movement of cash must be recorded and verified, efficiency becomes a strategic necessity rather than a mere preference. Inside the digital architecture of banking software, similar efficiencies appear. Each note processed generates an electronic record within the bank's internal systems. These records must be reconciled against Treasury databases, compliance modules, and foreign exchange reconciliation ledgers. The fewer entries required, the faster the reconciliation cycle completes. While smaller denominations produce exponentially more data points, larger denominations streamline digital reporting, cutting down on processing time and server load. In a system designed to operate at high speed, that difference can determine whether an institution processes hundreds or thousands of transactions per day. Operational experts emphasize that these details might sound technical, but they shape real-world outcomes. In a redemption scenario, the throughput capacity of machines, software, and staff determines how quickly customers are served. Banks aim to keep queues short and errors non-existent. Large denominations such as the 25,000 note align perfectly with these goals, fitting into systems engineered for scale and simplicity. From the moment a note enters a verification machine to the instant it is logged as a digital asset, fewer steps mean smoother processing. While the Central Bank of Iraq's monetary policy defines the legitimacy of each denomination, The practical side of handling those notes falls to banks and their partners. On the ground, this creates a quiet but meaningful divergence between mathematical equality and operational efficiency. 1,025 dinar notes equal 125,000 note in value, but not in effort. The larger note travels through the system in seconds, the smaller ones require sustained handling, multiplying human and machine involvement. It's a gap born not of economics, but of workflow engineering. To further understand this dynamic, we can look at parallels from other international currencies. When India replaced its large denominations in 2016, the Reserve Bank faced similar logistical challenges in counting, verifying, and replacing billions of notes. The lesson learned was clear: the fewer the pieces of paper, the faster the process. Whether dealing with euros, pesos, or dinars, large denominations always support higher efficiency when systems are under load. Banks worldwide apply these same operational standards regardless of national origin. Another factor driving this quiet preference is risk mitigation. During any high-volume exchange event, the risk of counting errors or machine jams increases. Smaller notes are more susceptible to wear, folding, and print variation, all of which slow down automated processing. The 25,000 note, by contrast, tends to remain in better physical condition simply because it circulates less frequently. That reliability improves both mechanical accuracy and teller confidence during intake. When time and trust matter, durability plays a key role. In addition, the auditing structure within large banks rewards consistency. Each completed transaction triggers automated reports that feed into oversight systems. Large denominations make these reports shorter, clearer, and easier to cross-verify. Compliance officers reviewing records for Treasury submission can confirm fewer data entries with higher confidence. It's an invisible but crucial step in ensuring accountability within the financial system. While many within the dinar community often focus on valuation or timing questions, these operational dimensions are where the real groundwork lies. Banks are not guided by rumor, they're guided by process. Their systems must perform flawlessly under regulatory scrutiny. Every note, regardless of denomination, passes through identical legal checks. What differs is the speed and efficiency with which that process completes. Larger notes make compliance smoother, not because of preference in policy, but because of optimization in practice. When considering the future of currency exchanges, it's also vital to understand that the bank's mission is not to evaluate investor sentiment, but to maintain transactional integrity. Staff are trained to follow strict verification and reporting guidelines. Each note's authenticity is verified against multiple data points, and all transactions are logged into secure databases. Reducing the number of physical notes per transaction streamlines every layer of that chain, from human oversight to digital storage. That's the essence of why large denominations are often seen as operationally favorable. Behind the teller counter, machines handle a large portion of the work, but human verification remains essential. A teller must visually inspect random samples, confirm machine readings, and ensure that every serial number aligns correctly. In such a structured environment, processing smaller denominations can easily double or triple the time spent per customer. Banks measure these differences meticulously. The 25,000 note emerges as a natural ally to these systems: less paper, fewer entries, faster throughput. It's also worth examining how central systems communicate with international regulators. When a currency exchange involves a foreign denomination like the Iraqi Dinar, data must pass through multiple verification networks. Fewer notes mean fewer serial records to transmit, reducing bandwidth use and potential transmission errors. In global finance, where data synchronization must be exact, even small efficiencies translate into significant performance gains. The 25,000 note, by representing more value per unit, minimizes data traffic while maximizing operational precision. Another aspect of this discussion involves staffing and human resource allocation. During large redemption operations, banks must manage schedules, ensure adequate staff coverage, and maintain security. The time taken to process each client determines overall capacity. With larger notes, staff can serve more customers without fatigue or delays. In banking, where efficiency is directly tied to labor cost, this subtle difference carries real economic implications. Fewer handling steps mean lower operational strain and smoother customer experiences. For banks, these benefits compound across entire networks. From local branches to national processing centers, fewer notes mean shorter queues, faster reconciliation, and more predictable cash flow tracking. These cumulative effects form the foundation of why many institutions lean toward large denomination efficiency. The preference isn't policy, it's physics and process combined. When the system is designed for scale, every unnecessary step becomes an obstacle to efficiency. All of this culminates in one key reality: financial institutions optimize for throughput, not denomination. The system rewards simplicity. Whether it's through machine handling, digital reporting, or staff productivity, larger denominations consistently perform better under operational stress. That's why, even without official declarations, a quiet inclination toward the 25,000 note naturally emerges in practical banking discussions. For everyday holders within the dinar community, understanding these details provides clarity. It reveals that the issue isn't about favoritism or hidden agendas, it's about efficiency management. All authentic notes remain valid and exchangeable, yet some fit the system more efficiently than others. Recognizing that truth helps demystify the process and encourages smarter preparation. As we continue this in-depth look at the practical side of currency processing, it becomes increasingly clear that modern banking relies on technology as much as on policy. Inside every major financial institution, an intricate network of scanners, databases, and compliance engines runs constantly in the background. These systems perform hundreds of micro-tasks each second, verifying serial numbers, checking anti-counterfeit markers, and ensuring that every transaction aligns with both national and international standards. Within such a finely tuned machine, efficiency becomes the ultimate measure of success, and the 25,000 note fits seamlessly into that environment. At the heart of this technological infrastructure are currency verification machines, devices calibrated to detect even the slightest irregularity in texture, ink density, or holographic placement. These machines are designed for speed but also precision. Each denomination must be recognized instantly by sensors, photographed, and compared against digital reference templates. When the number of physical notes increases, so does the time required for verification. The difference may seem minor in isolation, perhaps just a few seconds per batch, but across thousands of transactions, those seconds accumulate into hours of processing time. Fewer, higher value notes mean smoother machine cycles and lower strain on mechanical components. In large-scale redemption scenarios, banks often set up dedicated verification rooms equipped with high-speed counters linked to compliance servers. Each machine records metadata, the teller ID, timestamp, and note sequence. These data packets move to a secure database for reconciliation. The larger the volume of notes, the heavier the digital load. Here again, larger denominations provide an advantage by minimizing the number of data entries that must pass through the system. It's not about convenience, it's about maintaining system stability under high demand. Banks also maintain redundant verification layers to ensure no errors pass undetected. After physical scanning, software cross-checks serial data against internal blacklists and Treasury-approved authenticity codes. In some systems, artificial intelligence assists human verifiers by flagging anomalies automatically. When the number of scanned items is lower, these algorithms perform faster and with fewer false positives. The 25,000 note therefore streamlines not only mechanical but also computational efficiency, reducing the chance that machines trigger unnecessary secondary reviews that delay the process. Another major factor is data integrity management. Every redeemed note generates a digital record that must remain immutable for auditing. For smaller denominations, this results in vast data sets that require extended storage and backup procedures. Large denominations compress this information footprint dramatically. For IT departments responsible for cybersecurity and compliance, smaller datasets translate to faster encryption, simpler redundancy protocols, and lower energy consumption in data centers. What seems like a small operational detail on the surface actually supports both regulatory compliance and environmental efficiency. Moving deeper into the digital pipeline, each note's verification data eventually integrates with Treasury-linked reconciliation networks. These interbank systems confirm that every foreign currency exchange is properly recorded under anti-money laundering statutes. The fewer records transmitted, the lower the chance of synchronization delays between domestic banks and international oversight systems. For the Iraqi dinar, whose redemption procedures would necessarily involve multiple verification steps across borders, larger denominations minimize potential lag between national databases, a crucial element in maintaining real-time accuracy. Another layer often overlooked by the public is error handling protocol. When machines misread a note because of wear, crease, or misalignment, the system automatically diverts it for manual inspection. Smaller notes, being more frequently circulated, have a higher rate of such imperfections. Manual inspection takes considerably longer and requires a compliance officer to sign off on each correction. By contrast, 25,000 notes tend to be newer and better preserved, drastically lowering manual review rates. In quantitative terms, this reduces cumulative processing hours and allows teams to maintain momentum during peak exchange periods. The efficiency of larger denominations also extends to inter-departmental workflow. Once notes are verified, they move to vault management teams who package them for transport or deposit. The packaging process is governed by strict capacity limits. Bundles, seals, and tamper-evident bags all conform to set weight and dimension standards. Larger notes mean fewer bundles for equivalent value, lowering supply chain complexity. This benefit cascades through logistics providers, who can schedule fewer armored vehicle trips while still moving equivalent sums securely. Less handling equals less risk of loss, miscount, or delay. Security divisions within banks see an additional advantage. Fewer physical items reduce exposure to internal control breaches. Every note handled passes through multiple touch points where reconciliation must be confirmed. When these touch points multiply, because of smaller notes, the audit chain lengthens, creating more opportunities for discrepancies. By limiting the number of physical pieces, banks effectively tighten internal control loops. The 25,000 note therefore contributes to both operational efficiency and risk reduction. To appreciate the scale of these efficiencies, consider a simplified example. Suppose a regional redemption center processes 10 billion dinars in a single week. If that value arrives entirely in 25,000 notes, staff handle about 400,000 pieces of currency. If the same value arrives in 1,000 dinar notes, they must handle 10 million pieces. The time difference in counting, verifying, and storing those notes is monumental. Machines would need recalibration cycles. Staff hours would multiply, storage capacity would strain. The math of efficiency strongly favors the larger note. Another often missed aspect is reconciliation timing, the moment when all daily transactions close and totals are balanced against bank records. The fewer entries a system must reconcile, the faster that daily closure completes. Large denomination processing shortens this cycle, allowing institutions to refresh liquidity positions more rapidly and reopen operations the next morning without backlog. In the tightly scheduled world of international banking, where closing times are coordinated across time zones, even a 1-hour delay can cascade through multiple departments. The 25,000 note helps prevent that chain reaction. While efficiency dominates much of this discussion, customer-facing experience also matters. Redemption events are high-pressure environments. Staff must maintain professionalism while processing complex transactions. Shorter processing times per customer translate to calmer interactions, fewer disputes, and greater trust. From a public relations standpoint, banks have an incentive to favor the denomination that lets them serve clients swiftly and accurately. This quiet preference for the 25,000 note indirectly supports that objective without compromising fairness. It's also worth highlighting that central banks and commercial banks operate under distinct mandates. The Central Bank of Iraq defines currency validity and supply, while commercial banks focus on operational throughput. A preference for efficiency at the commercial level does not alter official policy, it simply optimizes workflow under that policy. In practice, both institutions benefit. The central bank maintains credibility through smooth international exchanges, and commercial banks demonstrate competency in execution. On a technological note, modern banks increasingly rely on optical character recognition, OCR, and machine learning algorithms to track serial numbers. The computational cost of these processes grows linearly with the number of notes scanned. Larger denominations effectively reduce the dataset size, enhancing processing speed and accuracy. Engineers designing these systems routinely test for throughput limits, and data consistently show that handling fewer, higher value notes maintains lower error margins across millions of entries. In addition to the mechanical and digital efficiencies, large denominations facilitate faster compliance verification for regulatory bodies. Agencies monitoring currency flow require periodic reports detailing aggregate values, serial ranges, and authenticity checks. When fewer notes constitute the same total value, compiling and verifying these reports takes less time. The 25,000 note thus contributes to regulatory transparency by simplifying documentation, a subtle but important factor in maintaining trust between institutions and oversight authorities. Environmental sustainability, though rarely mentioned in this context, also intersects with denomination efficiency. Fewer physical notes mean less paper consumption, reduced transportation emissions, and lower energy use for storage facilities. As banks worldwide push toward greener operations, adopting practices that reduce material handling aligns with corporate sustainability goals. The 25,000 note, by consolidating value into smaller volume, incidentally supports that broader environmental initiative. Inside training programs for bank employees, simulation exercises often replicate high-volume currency intake scenarios. In these simulations, staff practice verification and reporting procedures using mixed denominations. Results consistently show that larger note batches complete cycles faster with fewer errors. These outcomes reinforce the institutional learning that drives operational planning. When executives allocate resources for potential redemption events, they reference such data, ensuring readiness for the most efficient denomination handling possible. Another technical element is machine maintenance scheduling. Currency counters and scanners require periodic cleaning and recalibration based on throughput volume. Smaller denominations increase mechanical wear because of greater contact frequency. Handling 25,000 notes instead of numerous smaller bills reduces the maintenance load, keeping machines operational longer between service intervals. In high-stakes redemption settings, uninterrupted operation is essential. Downtime can create significant bottlenecks. Thus, the mechanical resilience associated with larger notes becomes a hidden yet vital benefit. From the standpoint of data security architecture, fewer transaction records reduce the surface area for cyber vulnerabilities. Each digital entry represents a potential vector for error or unauthorized access. Consolidating value into fewer records limits exposure and simplifies encryption management. Banks invest heavily in cybersecurity, therefore, any process that naturally minimizes digital complexity aligns with core protective strategies. Zooming out, the same principle applies across international clearinghouses that manage foreign exchange settlements. Whether in New York, London, or Dubai, clearing systems reconcile billions of dollars worth of transactions daily. Larger denominations enable smoother aggregation of Iraqi dinar inflows, making it easier to batch settlements without fragmenting value across multiple entries. In technical terms, it enhances liquidity mobility, a key parameter in interbank operations. To ensure fairness, it's important to reiterate that these preferences are operational, not preferential in value. All notes, regardless of size, carry identical legitimacy under the Central Bank of Iraq's policy. The distinction lies purely in how efficiently they move through complex systems built for speed and accuracy. Understanding that nuance helps dispel misconceptions that banks favor certain holders. The systems simply function better when denominational volume is optimized. As banking institutions refine their processes in anticipation of potential large-scale exchanges, they often collaborate with third-party technology vendors who specialize in foreign currency automation. These vendors design hardware specifically calibrated for each currency's dimensions and features. Testing consistently shows that high-denomination notes produce faster scan times and lower error rates across all machine types. The data reinforces the conclusion reached by operational experts worldwide in high-value, high-volume environments. Large notes deliver measurable performance gains. Before concluding this segment, it's valuable to address a recurring question within the currency holder community. Does this efficiency mean smaller notes will be disadvantaged? The answer remains unequivocal: no. All authentic notes are processed and redeemed according to the same regulatory framework. What differs is the pace of handling. Holders of smaller denominations might simply experience longer processing times, not lower recognition or altered value. Banks design procedures to ensure parity in outcome, even if the workflow varies in duration. As we have explored the reasons behind the quiet institutional preference for the 25,000 note span engineering, logistics, compliance, and even environmental dimensions, each layer contributes to a system that prizes accuracy and throughput. For investors and observers alike, understanding these mechanisms replaces uncertainty with knowledge. It clarifies that efficiency, not favoritism, drives institutional behavior.